Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. I'm Michael Hewson. Joining me again is Pepperstone Senior Market Strategist Michael Brown. And we've certainly got a fair bit to chew over today, Michael, given last night's tariff announcement from the US administration and the imposition of major tariffs on 185 different counterparties. Obviously, US markets have opened lower, continuing the declines that we've seen after their worst quarter, I think, since the second quarter of 2022. European markets are lower as well, unsurprisingly. But overall, even though there's an awful lot of what I would call wailing and gnashing of teeth when it comes to what it's doing to the markets, obviously the dollar's lower, I would argue that the response has been fairly muted, or am I barking up the wrong tree?
No, I think you're absolutely right. Hello, mate. Very good afternoon
Hello.
to you and to all our listeners, of course. I think you're absolutely right. I've got to be honest. When I left the desk yesterday evening, Wednesday evening, after the tariff announcement, we saw the S&P fall probably about 2% or so while Trump was speaking during that Rose Garden press conference. I've got to admit, I was thinking, we're going to wake up and the market's going to be 4, 5, 6% lower. And actually, although we are seeing, a chunky bout of risk aversion come in as you would expect, it does all feel, and I don't want to tempt fate, relatively orderly and relatively tame, given the fact that these reciprocal tariffs, or so-called reciprocal tariffs, were massively at the hawkish and punchy end of the spectrum in terms of what participants have been expecting.
Indeed. Well, before we go any further, let's do the obligatory risk warning, and then we can get into the guts of the tariff announcement, because ultimately I think while we can agree that they're punchy, they're probably going to overshadow pretty much everything over the course of the next week or so, including non-farm payrolls tomorrow or Friday, as well as the start of earnings season next week. Anyway, risk warning. Here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 75.9% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so that's the risk warning. The tariff list, I have to say that, while I think we can all agree that last night's list was, how shall we say, a little bit of a source of amusement.
Well, it was typical Trump theatrical style, wasn't it? Let's put it that way.
Well, indeed. I mean, I was looking at some of the retaliatory tariffs, and to my mind, there's been a lot of speculation as how they've arrived at those numbers. For example, there's one example there, Norfolk Island, right? It's getting 29% tariffs, right? It sits in the middle of, I think, the Indian Ocean, and it's Australian territory, and Australia gets 10% tariffs. How does that work?
Well, I can tell you exactly how it works, because some helpful people on the internet have actually backed out the formula that Trump used. And I've got to warn any of our listeners, particularly of your trade policy experts, this may hurt your ears, because the way that Trump has calculated what tariff and non-tariff percentage other countries are charging the United States is as follows. He's taken the trade deficit that country has with the United States, divided it by the amount of goods, importantly goods, not services, just goods, that country sends to the United States, and said, okay, well, that ratio, that percentage is what you charge us. So halve it, and that's what I'm going to charge you, and I'm going to say it's fair because it's only 50% of what you charge us. There is absolutely no economic rhyme nor reason to that whatsoever. And of course, for those countries where that horrible, horrific calculation yields a figure below 10%, Trump has turned around and gone, well, we're just going to charge you 10% for good measure, which is why the UK and Australia have these 10% baseline tariffs, but also why we've got some Pacific islands where there are no humans and only penguins inhabit them that also now have a 10% tariff on their heads. So, yeah, very, very comprehensive in terms of who's been targeted, and frankly very, very incoherent in how those levies have been calculated.
Well, yeah, I think Norfolk Islands is part of Australia, so surely it should have
But
the same
it's the same with the
tariff
Falklands.
as 82% was it,
Yeah,
the Falklands? I mean,
God
that
knows.
just makes no sense whatsoever, unless, of course, someone in the Trump administration thinks that's where penguin chocolate bars come from.
I to be honest, some of the stuff that they've said over the last couple of days, I really would not be ruling that out at this point. But yeah, I think that just speaks to and this is something that markets are really having trouble dealing with, is just this
How do you price
broad.
it?
Yeah, how do you price that? It's completely incoherent.
Mm.
How do you price in a scenario where pretty much everyone has got a different tariff rate on their head, and there doesn't seem to be much rhyme nor reason as to, firstly, how they got to that number, but perhaps more importantly, how the country in question can get that number negotiated lower.
Mm. And I think we can all agree that there will be an economic hit as a
Hmm.
consequence of these tariffs. The problem is we just don't know what that hit will be. And with that in mind, does it then make sense for, say, for example, the EU to basically push back and say, well, you're going to really damage your economy by implementing tariffs on our products into you. We are now going to do the same to ourselves. I mean, that
Yeah.
makes no economic sense. I mean, you're either for free trade or you're not. And for me, I think it's, you can argue that Trump is being economically incoherent. That doesn't mean you have to do the same thing.
Yeah, 100%. I would fully agree with that. I mean, I think, the way that the foreign exchange market has seen the sort of initial take on what Trump's doing is basically you're shooting the US economy in the foot more than you're shooting anyone else.
Yeah,
And I think
that's
for
my
me,
take.
that's right. Because the dollar's trading at roughly 6-month lows.
Mm,
The euro is up north of 111, cable pressing on towards 132 when I last looked just before I left the desk.
mm,
And that makes a lot of sense to me, because I think ultimately that is what we are seeing. Trump seems to have this sort of warped vision that in order to sort of enforce this America First agenda, they
mm,
need to go back about 40 years when they did absolutely everything within the country. I completely agree with you, and I think the UK's approach here is arguably the right one, where the government are saying, we're not just going to, and I must be feeling ill or something because I'm going to praise the government now, but Jonathan Reynolds, the business secretary, was on the radio this morning flat out saying, I'm not just going to listen to these siren calls that we slap the same tariffs
mm,
back on the United States. We're going to have a chat with them. We're going to try and negotiate a trade deal. And I think that is the way to do it.
mm.
Just because someone else is is enacting a policy, it doesn't mean you need to follow it. Certainly when
Yeah.
it's a policy as nonsensical as this.
Well, this is the point. I mean, I've seen an awful lot of people on social media, some very, sort of people that I actually respect, saying that we shouldn't be toadying up to the US administration. Well, no one's suggesting that we do. But at the same token, we also have a responsibility for the UK economy in doing what's best for it. And while Labour don't have a particularly good track record for that, I think in the context of what they're doing here, it's the right approach.
Yeah.
What you don't do with an economy that's flatlining is add additional costs to it when an awful lot of your exports, or quite a significant amount of your exports, come in from the US. Why would you do that?
Yeah, no, I completely agree with you. And I think actually in many respects, I know I stressed this when I was going through the maths earlier on,
Mm,
I think that the UK has got lucky that the Trump administration have only based these calculations on goods
mm,
and that they've excluded services, because obviously we export a hell of a lot more in the way of services to the US than we do in terms of goods. So we could have been hit a hell of a lot harder. But just moving on from the sort of amounts involved, I think the other problem that market participants are really, again, struggling to price is the fact that these tariffs are going to be implemented pretty damn quickly. The baseline 10%, that's going to take effect from midnight on the 5th of April, so
mm,
Saturday morning. And then the reciprocal levy, that's going to come in from midnight US time on the 9th of April, so next Wednesday. And I think that means that we've gone from a situation where, if you speak to market participants a few weeks ago, the general sort of theme was Trump will announce this, there'll probably be a 30-day sort of period of breathing space, and maybe these tariffs will never go into effect, to actually these tariffs are going into effect, and it's now a question of how, or indeed if, other countries are able to sort of wriggle their way out of them once they have been put in place. And I think it's much harder once the tariffs are actually signed, sealed, and into law to get out of them than it would be if that didn't happen.
Sure. I mean, there is a silver lining to this, I've noticed.
Go on.
That, well, UK yields are lower.
Well,
So this fiscal headroom that was basically being eroded by higher borrowing costs is now coming back in the government's favour. I mean, I'm looking at the 5-year yield, the UK 5-year yield, which was around about 4.5% only a couple of weeks ago. It's now 4.17%. And obviously the 10-year yield has come lower as well. And another byproduct of that is lower oil prices, lower commodity prices. Brent crude is down nearly 5%.
well, I think crude is really interesting at the moment. As you said, Brent down 5. I think WTI is down about 7 when I last looked. And certainly not going to be helped by news today from OPEC that they're going to be increasing production by 411,000 barrels a day from May, which is 3 times the expected increase. And I think what we're seeing here is a little bit of a, well, actually not a little bit, a significant battle for market share that is now going to take place between OPEC Plus and all of the shale producers in the United States, whereby they are, certainly OPEC seem now very, very price insensitive, and they're effectively saying, we don't worry about where the price is, we just want to make sure people are buying our crude and not the crude that Besant and Trump keep trying to get everyone to drill, baby, drill.
Well, actually, this could have a significant effect on the drill, baby, drill policy, because if you drive oil prices down, the cost or the return on capital employed goes down as well, because you get less price per barrel of oil, which
and you
means
can
essentially
shout,
less profit.
and you can shout the slogan as loud as you want from whatever rooftop you want, but if the firms involved are not going to get an adequate return on that investment, then they're simply not going to invest and do it in the first place.
But it also, I think, holds the government's energy policy below the line, because ultimately, if you're looking to get US gas, do you really want to be beholden to a president who can basically slap tariffs on imported energy at the drop of a hat?
Absolutely not.
So,
absolutely not.
For me, I think there needs to be a significant rethink on the part of government policy when it comes to energy. And you can talk about solar and wind till the cows come home. I'm sick and tired of hearing that, because ultimately for me it's about baseload and it's low manufacturing costs. Now, if you want to reshore manufacturing because you've got a lower cost base here or a lower tariff base, you need lower energy costs. So you need to encourage people to reshore maybe manufacturing back to the UK because of the lower tariff that we've got here. But the only way to do that is get energy costs down.
Yeah, no, absolutely. I think that your point around, the volatility or the uncertainty associated with how the Trump administration are acting, I think that's one thing again that we see showing up in the performance of the dollar, because just turning back to the FX space for a second, traditionally, if you've got the S&P down 3, the Nasdaq down 4, European equities down similar amounts, you're going to see the dollar rallying through the roof. But actually, you've got to think, participants are trying to hedge political uncertainty and trade uncertainty associated with the US. Which asset is by far and away the most exposed to that? It's the dollar, which is why it's just not attracting any demand whatsoever. And I think at some point, and I don't know, sadly, I don't know when this is going to happen or what the tipping point will be, but at some point, I think the market is going to force a bit of a rethink as to how the administration are dealing with things.
I mean, I've heard a lot of chatter being recycled again about, maybe the reserve currency status of the US dollar.
Oh, well, that's not. That's not going to change.
It's not going to change. I don't see how it can. What it may do is encourage people to perhaps conduct trade in currencies other than the dollar. But ultimately, when the whole financial system is completely underpinned by the US dollar. Any transition away from that is going to take years.
Yeah, exactly. And also, any transition away from that will need a viable alternative,
Yeah,
which
and
simply
we
is
don't
not
have one.
present at the
We don't
moment.
have one.
Whether that be in terms of the big picture financial markets, or even, the other classic example that I sort of lean on quite a lot is if you go to a developing nation and you carry dollars in your back pocket, you're going to be all right. You're
Mm,
going to be able to spend those, and people are actually going to probably want you to spend those over their local currency.
mm,
If you walk around that same developing nation, wherever it may be, with euros or with pounds sterling,
mm.
they're not going to want it. They're probably not even going to know what it is. And that, frankly, unless and until that situation changes, the dollar is still going to be, king of the hill. That's not to say the value of the dollar can't decrease as we're seeing at the moment, but
Mm.
in terms of its market share as an overall usage, I don't think that's going to diminish anytime soon.
No, I would agree with that. I think every time something like this happens, you get the usual debate, the demise of the dollar, yada, yada,
Mm.
yada. Well, the thing is, if you're going to make that argument, you then need to make the argument of what you put your money into,
Yes, exactly.
apart from the dollar. Euro? No, because it's still not a proper currency. There's no common fiscal policy, there's no
Mm.
common treasury. And ultimately, until you have that, then it's not a non-starter. The Chinese currency, again, it's at the mercy of the whims of the Chinese Communist Party.
Yeah,
Um, and what are you left with? SDRs? Really? Special drawing rights? IMF?
go
Give
and
me a
spend
break.
them.
Exactly.
That's just, you can't. So
You can't.
yeah,
So at the moment,
it's almost by default, isn't it?
we're stuck with the dollar until such times as an alternative currency manifests itself.
Mm.
And ultimately, I think for me, this is not about the dollar. This is about the US government. And I
Mm.
think looking beyond this volatility, people are, I think, getting too hung up on the volatility. I think, stock markets are still, I think, the optimal place to be. I think the last thing that Trump will want to do is undermine his population's 401ks to any
Mm.
significant degree. So for me, presidents come and go. I think the question people should be asking, what comes after Trump? Because he's only going to be there another 4 years.
Yeah,
He talks about a third term.
not going to
Okay,
happen.
good luck with that.
Yeah. No, I think you're absolutely right. And, I've made the argument probably on the podcast, certainly in some of the notes that I've been writing recently, that, the overall strategy is still one of short-term pain for long-term
Mm,
gain. And if you set aside all of the tariff and trade rhetoric that clearly and logically participants have been focused on this week, the overarching aim of the Trump administration is to ultimately, firstly, improve the US economy by reshoring various bits and bobs, and secondly, to make that US economy more resilient by reallocating resources away from the public and government sector and into a much more productive private sector. If you
mm,
can do that, and if you actually see the Trump administration pull that off, then I think that is a massive, massive bullish impetus for the economy and by extension for the equity market in the longer run. It's
mm,
just this sort of short term turbulence that markets need to sort of hurdle over right now. And I think the problem is with tariffs and with the protectionist trade rhetoric we see, it introduces two risks that are very, very difficult to manage.
mm,
The first of those being a significant downside hit to stateside economic growth. And the second, which runs concurrently with that, is a significant upside risk to United States inflation. I mean, a lot of the banks have been putting out notes saying inflation could rise somewhere near 4 or 5% in the second or third quarter of this year. And I think that's a real issue for the markets because you go as an investor or as a short-term trader, you're going, okay, well, do I focus on downside growth risks and go defensive on that? Do I take a hawkish play on policy because of the upside inflation potential? How do you position yourself in that environment? And we are not even 24 hours on from these tariffs being announced, of course, when we're recording this. I think it's going to take a number of weeks for everything to properly shake out and become a little bit clearer.
mm. I mean, you say there's an inflation risk. I would argue potentially that could be a deflation risk.
In time, yeah, I would agree.
So how do
You
you
would,
price that?
well, this is it. you can play it both ways. You can
Mm.
argue there is a deflationary
We're already
risk
seeing it
because
now in energy prices and commodity
Mm,
prices more broadly. Copper prices are low. I mean, obviously, I know that's on the back of growth concerns and what
yeah, yeah,
have
yeah.
you. But if you get a slowdown in growth and companies can't sell their products, they're going to start cutting prices.
Yeah, I mean, there's sort of two ways you can ultimately play it. I think most people would say in the long term tariffs are probably deflationary if you give it long enough, 12, 18 months or
Yeah.
so, because you see that big hit to demand, which, as you say, results in discounting effectively. The other argument to that is if you get over that initial sort of 6, 9 month hump where prices move higher in a transitory fashion as a result of the tariffs being imposed. If the tariffs lead to, let's say, a reshoring of manufacturing, that's going to result in much higher production and labor costs, which are then the second round effects that get passed on and result in, potentially stickier and more stubborn price pressures. So I almost feel like we should apologize to our listeners here because I feel like we're sort of provoking more questions than we're answering at this moment in time. But that's just the degree of uncertainty there is out there at the minute.
But that's essentially what everyone else is asking.
Yeah,
And
and if everyone's asking it, no one can price it, which is
no,
why we see the market trading like it is.
exactly that. I mean, I'm looking at the FTSE 100 now, and it's down towards the January lows, and just above the breakout point that we saw when it broke above 8,400. So it's that real key support level there, which saw us break higher, move up to 8,875, and now has seen us slip back. So it's eyeing a key support area just above the 200-day moving average. Similarly, the DAX has fallen quite sharply, but again, it's well off its lows. It's below the 50-day moving average, well above the lows that we saw in February, around about 21,000. So for me, yes, we've seen a sell-off, but for me, we're not in any danger territory at the moment of seeing a significant crash. And I hope I'm not. I hope I
I hope we can clip that up in a couple of weeks.
I hope I haven't put the mockers on it. But when you've got the economist coming out and saying, "Oh, this is terrible. We're going, the market's going to massively go lower," I think that's enough of a reverse indicator to suggest that maybe we're near the bottom. I don't know. I'm sort of.
You're going to stop talking now, aren't you?
Yeah. But yeah, I mean, we have rolled over, but we're still above, the lows that we saw in February for the DAX. Yeah, we're well off the March highs, but we haven't come crashing off. The damage is being done in the US.
Yeah, absolutely. You're 100% right, and I think the key question from a European perspective is going to be the response to tariffs ultimately. If as again, to sort of revisit the point we made earlier, if we do see, for example, the EU starting to throw around tariffs of their own, then you're probably going to see a much more significant leg lower in terms of
And I wouldn't
European
rule
equities.
that out because they're
No, I
stupid
wouldn't
enough
rule
to
it out
because they're
either.
stupid enough to do it.
Well, and also if you look at, and again, if you're listening to this back in a day or so, take this with a bit of a pinch of salt. Things may have changed, but Bloomberg sources reporting earlier that France and Germany want the EU to go harder. The Spanish PM was on the wires saying we need to impose tariffs of our own. I mean, to be frank, these people just don't get it.
No, they don't. But they're politicians; they never do.
Well, quite.
It's all about signalling and not about thinking. And for me, you need to be doing, if you're in a hole, you don't jump in the hole with a person who's digging it.
No, with a shovel of your own.
Yeah, exactly. And that's what Trump is essentially doing. So for me, it's best to look into the hole and think, no, I'm not going to jump in there.
Yeah. I make you absolutely right.
Knock yourself out. Worry about what's going on inside the EU and how to mitigate it there, rather than essentially hurting the very people you're supposed to be looking after.
Yeah.
Anyway.
The other, I was going to say the maybe the last point we'll make on tariffs for now is, and this has gone a little bit under the radar, is everyone's focused on China. Everyone's focused on the EU, as you would expect. Some of the other countries that have gone a bit under the radar, places like Vietnam, Cambodia, some of the other Southeast Asian countries. And the reason I mention this, and I think it's important, is because a lot of companies over the last sort of half a decade or so, you think about Apple, Nike, they're two that obviously spring to mind. What they've done is they've gone, okay, we understand that Sino-US relations are souring quite significantly, so we are going to look for other jurisdictions within the same region with similar low labor costs and low production costs where we can move our production to. Vietnam was one of those locations that a lot of countries moved to. They've now been slapped with a 46% tariff. And I think that's gone a little bit under the radar because everyone's kind of going, oh, Vietnam, does anyone care? Well, actually, yes, because their trading relationship with the US has become humongous in recent years. And certainly in terms of Apple and Nike and a few of these other individual equities, they are, to put it politely, in a bit of a pickle at this moment in time.
Yeah, I think what is clear is that I think an awful lot of more global companies are going to have to localize their production a lot more.
Yeah.
So Asian production basically goes to Asia, US production goes to the US. The problem with that is a pair of Nike trainers is going to cost a hell of a lot more in the US than it does in Asia. So maybe that's a lot of foreign holidays for US tourists to bring contraband back. I don't know.
Well, and of course, the other thing is there's certain things that you can't do that with. For example, coffee springs to mind.
Sure.
A lot of coffee is grown in South America. You're not going to suddenly be growing coffee in South Texas. That's just not going to happen.
Or anywhere in the US for that matter.
Absolutely. And then there's other things where not necessarily geography, but desirability dictates that. For example, things like watches. Swiss watches are the sort of pinnacle of the industry. And I'm not being funny, but no one's going to buy a South Carolina watch. Everyone wants a Swiss-made watch. So there are certain things where that reshoring and that localization just can't happen for whatever reason.
Indeed. Okay, we talked about equity markets. Obviously, there is a risk to the downside, but at the moment, I think as far as European stocks and the FTSE 100 are concerned, we're still above those key support levels. So for me at the moment, while we're seeing an awful lot of volatility, I'm not overly concerned about a big sell-off at this moment in time. That doesn't mean that we won't get one if the wheels do really come off. But I think for me, it's incumbent upon our politicians to be measured in their response and allow, the dust to settle a bit and see where it all basically, see where all the cards lay now that the table's been completely upended. As far as the dollar's concerned, obviously we've broken through 110 against the euro. We've broken through 130 against the pound. The bigger question for me is where do we go to next? I mean, obviously we've seen a big move higher in euro dollar today, a very strong move higher, which brings us, I think, to the next long-term target for me, I think, which is the September and October highs of around about 112. So I think if we can hold above 109.50 on euro dollar, then we can conceivably see 112 over the course of the next couple of weeks, perhaps, maybe even longer.
I mean, again, I think it comes back to that response that we were just, alluding to. I think right now the momentum is clearly in favour of dollar bears, and but personally I agree with you. I don't see that changing anytime soon. But again, if we do see sort of the European Commission on some sort of economic suicide mission, then I would not want to be long of the common currency in any way, shape, or form. I think again it's just that. And there's one of the things that's been interesting about the sort of impulsive nature of the moves today is there is still a big lack of conviction more broadly in terms of the outlook and in terms of how traders should be positioned, which makes me just a little bit nervous that if we do see a headline to the contrary of the base case that the market's now priced in, does this all end up reversing in the blink of an eye?
Yeah, I mean, I'm looking at my cable chart at the moment, and obviously we've now broken above 130.20, 130.30, which was, I think, the key resistance level on the top side. We're now above that. We've been as high as 132. The next series of peaks was in September, was when we saw the move to 134.5. So I think for me, momentum is clearly on the pound side here. I'm looking at my chart. 50-day moving average is pointing higher. The 200-day moving average is pointing higher. I think it's going to take an awful lot to drive the pound much below 129 at this point in time, which suggests that, maybe it's time to start booking a US holiday, perhaps.
Well, I was going to say, when are you going back?
Well, the plan was to go back in September, October, but
You might have to bring that forward.
well, I might have to, but the missus has sort of poo-pooed that, so we might have to go next year instead. But yeah.
Well, anyway, I was speaking of the US. We've obviously got the jobs report due tomorrow,
Yeah.
which, I mean, at this point,
Does it really matter?
I was going to say it feels like, and again, I could be a hostage to fortune here, but it feels like the most inconsequential jobs report I can remember for a hell of a long time. I guess the big worry is if we get a big downside surprise, then that is, and of course, this data references March, and it references the employment situation as of the week containing the 12th, so way before last night's tariff announcement. But I think if we get a big downside surprise, then that's just going to crystallize and worsen all of the growth worries that markets already have, because you're at that point you're saying, okay, we've got tariffs, we're pricing that, we're getting to grips with that, but hang on a minute, the labor market was a hell of a lot weaker than we thought before any of these tariffs were even imposed.
Yeah. Do you think, though, that it's going to be a weak report? I mean, the ADP report was actually better than expected. Private sector yesterday on the Wednesday, 155. We're expecting a number of
Well,
around
that
about
tends to be a bit of a
180.
contrarian indicator at this point, doesn't it?
It does, but it doesn't point to a jobs market that's struggling, does it?
No, I agree. I think, yeah, I mean, again, it's one of those where, and I think we're probably in the same situation with the February report, where you could almost play tit for tat with leading indicators, because you've gone ADP was fine, I'll go, well, Challenger layoffs were at their highest level since COVID, you'll go, initial jobless claims didn't move between the survey weeks, and I'll go, well, both the ISM manufacturing and employment and services employment indices were below 50. So it's kind of 6 of one, half a dozen of the other at this point, I think. And again, that just exemplifies the uncertainty around it all. But one thing I think we can be certain of is that whatever the jobs numbers say, it's not going to change the thinking on the FOMC one even tiny little bit.
We've got the Fed minutes next week.
Yes, we do.
As well as US CPI. So we did see a little bit of a bump higher in the CPI numbers for February. They went to around about 3%. I think, was it 3%?
Yeah.
So we're expecting that to slow a little bit after the pop higher. So for me, I think next week's CPI report, I don't think we're going to be overly concerned about it. I certainly think Jay Powell wheeled out the transitory word at the last Fed meeting. And I think when you look at what the Fed did with respect to its end of year target for unemployment, they're not overly concerned about unemployment at this point in time, nudging it up to 4.4 from 4.3, upgrading their inflation forecasts and nudging down their growth forecasts. So I think the key thing for me is the uncertainty, easy for me to say, which I think surrounded everything that they articulated about the US economy in the change of wording in the statement.
Yeah, no, I think you're absolutely right, and I think we've got to be very, very careful for the next 4 weeks or so in terms of the economic data that we're getting, for a couple of, and actually probably for longer than that. I think for a couple of reasons. One, because a lot of it will refer to the period before these tariffs. So anyone going, CPI was at X% in March, yeah, great, but it doesn't really mean a lot at this moment in time. The second point, and this relates particularly to the GDP numbers, which we don't get until the end of the month, of course, but a lot of data is being skewed by people trying to front run those tariffs. And what I mean by that is, if you're an importer in the United States and a bloke's just been inaugurated saying, I'm going to slap tariffs on everyone in 3 months, well, frankly, you shouldn't be running that business if you go, okay, we'll just wait 3 months and see what happens. You try and stockpile and build up your inventories at current pricing and at current import levies and tariffs to get ahead of the curve and to prepare for whatever may happen. So again, that is starting to, and particularly things like GDP estimates, that stockpiling and that front running on importing is really starting to skew some of that data to the downside. So, yeah, I think we're in a bit of a weird dynamic where data doesn't mean a lot, but it could move the markets a lot because any negative surprises are going to just be jumped upon as a sign that everything is going downhill faster than we expected.
Yeah, and the downside to that is if you build up inventory in anticipation that you're going to need it later and the economy slows down, suddenly
Mm.
you've got excess inventory and you basically start adding up storage costs.
Yeah.
So, as I said, it goes back to what we were saying earlier. It's very difficult to price that.
And there's a payoff as well. If you build inventories in Q1, you run down those
So you
inventories
produce in
in the
Q2.
following quarters, right?
So yeah, exactly. So there could be a boost to Q1 GDP,
Mm.
which is then completely offsetting Q2 GDP.
Yeah, absolutely.
Yeah, and I think it was interesting that earnings season starts next week. We've got JP Morgan Chase, we've got Wells Fargo, and we've got Morgan Stanley Q1 numbers. And I think one of the things that I took away from what Jamie Dimon said when JP Morgan reported their full year results for last year was that the US economy was still resilient enough, although susceptible to inflationary pressures and a deterioration in geopolitical conditions. Well, here we are, Jamie.
Yeah.
So, I think this is the biggest concern going forward. And these concerns are starting to manifest themselves. So I think it'll be really interesting for me when JP Morgan do report their Q1 numbers as to how Jamie Dimon sees the US economy now compared to what he was saying at the end of Q4.
Yeah, absolutely. Because in terms of those risks, it's kind of 2 out of 2 that have materialized, really, in terms of those downside risks that he was flagging. I think bank earnings are going to be interesting. I must admit, if you'd have asked me this 24 hours ago, I'd probably have been a lot more interested in them than we are now, given that everything that's changed. But it's been an interesting first quarter for banks because what we've seen is huge market volatility, as we know, which you would expect for the likes of JP Morgan will boost their trading revenues quite considerably. But at the same time as that, this boon in M&A and deal making that folk were expecting to happen at the start of the Trump administration, it just hasn't materialized whatsoever. The environment has been, frankly, too uncertain and too volatile for much activity in that realm to take place. So you then go, from the institutional corporate side, how do those two factors sort of net each other off? And then, of course, the other thing that participants will focus heavily on is commentary around the consumer. We've seen consumer sentiment souring significantly, although there are, quirks in that data, to say the
Along
least.
political lines.
Yes, exactly. But is that showing up in what the banks are seeing in terms of the credit that they're extending, and also in terms of the spend that their customers are making? I think that macro commentary will be of particular interest.
Well, I'm looking at JP Morgan Chase and Wells Fargo share price right now, which is why I'm looking off up to my right, because that's where my charts are. And Wells Fargo's down 7%. JP Morgan is down 4.6%, and they're both sitting on their 200-day moving averages, and just above the lows that we saw on the retreat from the record highs that we saw January, February. So we're at quite an interesting point in terms of the share price and the long-term averages for both of these banks. So it'll be interesting to see whether or not this particular move lower takes out those February lows, because if it does, it could close the gap that we saw, the Trump bump gap that we saw at the beginning of November.
So if that was the Trump bump, are we now in the Trump slump? Have we moved to that phase of things
Well,
yet?
at the moment, we're filling the Trump gap. No.
You might have to edit that out.
Sorry,
we're very immature viewers. We should know better at this moment in time, shouldn't we?
There's a big gap where we've gapped higher, and now the price action is filling that gap. So
yes,
that gap will either act as support for a rebound. If it goes back through it, then we'll see a further sell-off. At the moment, I'm struggling to see why we would, but who knows in these markets? They're so fickle at the moment, and ultimately, US banks have been one of the outperformers when it comes to asset class over the course of the last 5 or 10 years. So,
Yeah.
what is a realistic valuation of a US bank? Despite the fact that JP Morgan did post record profits and record revenues in its last fiscal year. So,
Yeah.
again.
What else have we got going on next week that will inevitably be overshadowed by what the Orange Man has to say?
Well, we've got monthly GDP numbers out of the UK. We've also got full year numbers from Tesco. Interesting. Tesco share price is up
Every
four and
little
a half.
helps, I suppose.
Well, indeed. Oh. Tesco share price is up 4.5% today. That's an interesting one, actually, because earlier in the middle of March, we saw a big decline in Tesco share price. In fact, all supermarket shares saw a big decline, 18% Tesco's, on the back of Asda launching a price war. And I think there was a concern that perhaps UK supermarkets would basically end up slashing their margins, affect profitability. For me, I think a lot of that was overdone, certainly when it comes to Tesco's, because it's way out in front when it comes to being the UK's #1 supermarket. But today it's up 4.5%. And I'm struggling to understand why, aside from the fact that it had a really big fall in the middle of March on the back of that Asda news. I mean,
Got to be honest, I'm a bit annoyed you said that, because I don't have a narrative for it either. To be completely honest, I was hoping you might have pull something out your hat.
Well, I think it was just potentially overdone. The sell-off, I think, is potentially overdone. It's come too far, because it's come down from 400p or just below 400p to 320 in the space of about 2 or 3 weeks. Which, for me, when you look at the trading numbers for Tesco's post-Christmas, doesn't really warrant a decline of that magnitude. It's still a very good business. It's still got fairly decent operating profit in cash flow. Cash flow is expected to be around about 1.5 billion. When you've got that amount of cash flow, I think a price war is the least of your problems.
Yeah, no, absolutely. I guess
you're the biggest. You're the biggest. You're the biggest in the sector.
Yeah, and it's not even close. I guess the other thing, speaking of the Asda price war, which is a really good point that you bring up, are we going to sort of see the mirror effect of that, whereby, the market takes Tesco's report as a barometer for the consumer and the sector at large?
It's a good point. And to be fair, I mean, this is just their full year numbers. We pretty much know what we're going to get from them. The big question is how do they see the outlook? We already know that costs are rising across the sector. I mean, Tesco's national insurance bill is expected to rise by an extra £250 million per year over the next 4 years.
Yeah.
So that's £1 billion of extra costs, assuming, of course, there are no further changes to national insurance rates.
Which you cannot rule out whatsoever.
So you take that $1 billion. So that's the baseline case of extra costs that Tesco's budgeted for out to 2028. So, I suppose it's really a question of how much more they can absorb. But supermarket sector is really competitive.
Yeah.
And ultimately, we've seen a big decline across the sector. So I would argue that some of the pessimism may be a little bit overdone. So you've got full year numbers out of Tesco's. For me, it's about the outlook and less about the actual numbers themselves. And we've got February GDP out of the UK. So
which doesn't matter.
Which doesn't really matter. But I think
if we're being completely honest.
But I think what it does do, Michael, is it outlines the very precarious state of the UK economy as we head into 2025. January was disappointing.
Yes.
We saw a pickup in December of 0.4, which was largely driven by government spending. Now, as we're heading into February, March, and obviously we've got April, awful April, whatever you want to call it, I can't see much upside for UK GDP at the moment.
No, not at all.
Given certainly not from here where we are now. In April is going to be. I can't see much upside. Much will depend, I think, on what the government does with respect to their attitude towards the US and the tariff announcement. If they play this right, then they can mitigate some of the damage. But I still think they need to reverse policy on a number of key areas, one of which is energy.
Yes, absolutely. I fully agree with you on that. Sadly, my hopes that they do that important reversal are relatively slim. But what I would say in terms of UK GDP is, fundamentally, if you zoom out monthly GDP has been basically a rounding error away from zero for the last 18 months or so, particularly when you strip out the implication or the government spending component. The private sector, private investment, private capital investment has just been on its knees for some time now. Next week's data isn't going to change that. And as you say, there's enough bad news over the next quarter or so that probably isn't going to change it much either. And we're just going to sort of bumble along in this anemic growth environment for the foreseeable future, I think.
Yeah, and economic conditions are challenging. We've seen that.
Yeah, absolutely.
With respect to some of the releases that we saw in the past couple of weeks. Now, last week, obviously, we had Andrew Sentence on, and we talked at length about the spring statement and the economic outlook. So it didn't give us the opportunity to look back at some of the results that came out, namely Kingfisher, Travis Perkins. They finally released their results.
I bet they wish they didn't.
And I bet they wish they didn't, but maybe that's why they delayed them. They slid to a 16-year low on the back of the results. Revenues
got absolutely demolished, didn't they?
They were, absolutely. 4.6 billion in revenues. Operating profits fell 99% to £2 million from 161 million the previous year. And the company fell to a loss after tax of £77 million. A large part of that was down to impairments across branches and what have you. And the builder's merchant also posted a cautious outlook. Now, we did, I think Good Money Guide released some viral TikTok videos of when we talked about the fact that obviously Travis Perkins had pulled their results. And, why Travis Perkins is suffering more than its peers, I think it's hard to tell, because obviously Kingfisher, B&Q, that was suffering. French division continues to act as a real drag on the business. But judging by some of the feedback that we got from that Travis Perkins short video suggests that pricing is a key area for Travis Perkins. The prices are too high.
Yeah, absolutely. I was just going to say, a lot of the sort of anecdotal commentary on there was around pricing, and they are just uncompetitive. And I think when you couple that with the fact that the firm clearly through a sad turn of events has no permanent CEO at the moment, and they've just issued a pretty chunky downgrade to their earnings guidance, if investors are kind of scratching their heads going, what's to like about this? It's an uncompetitive stock with seemingly, and I'm no expert in the building sector, as you probably guess, but it's an uncompetitive business with no plan or seemingly no strategic direction as to how they're going to turn things around. I don't wish to be overly pessimistic, but where's the bull case on that?
I mean, the main gripe, according to the video shorts, is high prices, and that seems ironic when you consider management were blaming that price deflation for their disappointing results, which suggests to me they weren't cutting prices enough.
Well, quite. Yeah, maybe they should have gone a bit further on that, and they would have been in a better situation. But those earnings did not go down well at all.
And then we looked at Fever-Tree, full-year results. They did deliver a tonic to shareholders despite a 3% decline in UK revenues. So there we go.
A tonic to shareholders. God almighty. I'm going to need a bloody gin and tonic after this, I think.
Yeah, well, this is just water, mate.
Oh, yeah, of course it is.
And obviously we had Nike's numbers as well and FedEx's numbers, and Nike's numbers didn't do it for shareholders. The shares fell sharply. Another decline in quarterly revenues. So again, I think their problems are going to come into sharp focus because of obviously the tariffs, given the fact that they make an awful lot of money out of Asia. So 10% decline, 8% decline, and Q3 revenue declined by 9%. So you're getting some big declines in quarterly revenue, which suggests that essentially people aren't buying their shoes.
Yeah, absolutely. And of course, now they've got the tariff issue on top of that as well. It's all becoming a bit of a perfect storm, really, isn't it?
And they guided lower as well. So, yeah, as you say, a perfect storm. And FedEx again.
Taking a bit of a shoeing, haven't they, Nike, really?
Oh, just a bit. Just a bit. So those, that was essentially a quick summary of what we would have discussed last week. So pretty much rear view mirror stuff. But ultimately, I think from that, I would suggest that probably Fever-Tree are probably the best of that bunch.
Yeah. Long gin, short trainers.
Yeah, that sounds
That
like
I was going to say I quite like that
quite
trade.
like that trade.
I
Yeah,
like that trade.
that's a
Not
good pairs
investment
trade.
advice, of course, but
That's a good pairs trade, isn't
it sort of sums up my life actually.
it? Anyway, so what else have we got next week? I think we got Raspberry Pi's full year results actually, and that was I think the sole IPO that the UK market came from last year. I think that was
Certainly
pretty
the
much
only one that anyone remembers. That's
that
for
was.
sure.
I think that was the sum total. I think of UK IPOs last year.
It is pitiful, isn't it? I know we laugh, but
Raspberry
it is
Pi.
disgraceful.
Or was that this week? I can't remember now. No, I think it was this week actually. Now you mention it, I think it was this week.
Are we
Yeah,
about to preview something that's already happened?
it's already happened. Yeah, yeah. I read down too far. I skipped over it when I was talking about the results from the last couple of weeks. But Raspberry Pi shares, they posted a decent set of numbers, given the fact they IPO'd at 280p, and they're now well above that. So it's 458, even though they are down 4.5% today. But again, it's a tech stock, isn't it? So
Yeah,
UK
absolutely.
stock. So I think we pretty much covered everything that we need to cover. Gold. Let's have a look at gold.
Oh, actually, I wanted to talk. I've got a little bit of a tale on gold.
Okay, let's hear it.
This is a
Or
nugget.
tailings.
It's a bit of a
Tailings.
nugget, and I do have to give thanks to Henry Gilbert at News Corp for pointing this out to me last night. So thank you for that, Henners. Gold obviously rallied significantly over the last couple of months. We were trading at record highs at $3,150 an ounce into Trump's announcement last night, or on Wednesday evening, I should say. And gold since then, I mean, we have paired losses a little bit this afternoon, but we have come off the boil quite significantly. And a lot of people have been scratching their heads going, the market's risk off, gold is a safe haven, why the hell is it falling through the floor? Well, one of the reasons why it probably is because what was underpinning or helping to underpin the gold price was, again, going back to what we were talking about earlier, this idea of people front running tariffs, basically bringing gold into the United States, importing it before tariffs were imposed, again, just to hedge the risk that tariffs will be imposed and increase the cost of those imports. Well, White House officials very late after I'd gone to bed on Wednesday evening said that gold will actually be exempt from the reciprocal tariffs that Trump has imposed. So effectively what you're seeing is, opposed to a haven move, you're actually seeing the market unwind some of that sort of tariff risk premium that was priced in, and I think that's probably why gold has traded lower despite this risk aversion. But again, once we sort of get over that hurdle, I think the bull case remains relatively solid.
Yeah, I mean it's still above $3,000 an ounce, so we've been as high as 31.67. I mean, it's good. I thought you were going to regale me with that note that you sent to Bloomberg the other day, which
No, I wasn't going to sing. Don't you worry. We'll have to get Spandau on for a little cameo appearance at some point. But no, I was hopefully providing some value rather than some puns for once. I know that's rare.
I think you mentioned it deliberately so that you get your comment picked up. We've all done it, mate.
Well, if they want to buy me a beer, then they can.
Alrighty. Well, we'll save that for tomorrow evening, mate. when I see you. So,
Indeed. Oh yes, I forgot I was seeing you tomorrow.
Yeah. All right. Well, I think we pretty much. I think we've pretty much thrown a blanket over everything that there is to discuss. As I say, if you find these videos educational, informational, what have you, drop a comment. You know, drop something in the comments. Feel free to throw us some questions. We'll try and answer them if we can. Just a quick reminder that those Facebook scams are still out there. Please report them. I'm having a real problem getting Facebook to take them down. They're being reported on multiple occasions and they're still up there. So I'm keeping my options open as to what I'm going to do next. So I'll see you all again, same time next week, and I'll see you tomorrow, Michael.
Indeed. See you later. Bye for now.
Cheers. Bye for now.